Welcome back to Bite-Sized Business, the channel where we use financial metrics and ratios to gauge the financial health of companies. In today's installment on defense contractors, we will take a bite into Northrop Grumman, the company behind the B-2 Spirit and the B-21 Raider. The company was the result of a merger between Northrop and Grumman, two American aerospace companies with defense ties. Northrop was also founded in part with Douglas Aviation, which would later be part of McDonnell Douglas, which itself was acquired by Boeing. Looking at the main course, we can see in the last 12 months the company has done just shy of $41 billion of revenue. They have done $4.65 billion of EBITDA and just shy of $2.4 billion of net income. Moving over to the balance sheet and looking at their most recent quarterly report, we can see the company reported total assets of around $48 billion, total liabilities of $33.5 billion, which consists of $16.5 billion of total debt, or about half debt. This leaves us with a total equity of $14.7 billion. Now looking at the cash flow statement, we can see the company has done $4.2 billion of operating cash flow, which dwindles down to $2.48 billion of free cash flow, in part from the $2.4 billion of stock they repurchased, as well as the $1.16 billion the company paid in dividends. Off to the main course, we can review some of the information off of those financial statements. So today's company was Northrop Grumman, who trades under the ticker symbol NOC. They are in the defense industry and more of the aerospace subsector. They did revenue of just shy of $41 billion in the last 12 months. This is up from their 2022 number of $36 billion. Looking at EBITDA, we kind of see a different story where they posted $4.6 billion, but in 2022 they posted $7.6 billion, and I believe it was even higher in 2021, which means that they're kind of falling back, but they've stabilized at around that $4.5 billion mark. They did net income of $2.37 billion. This is up pretty heavily actually from their 2023 numbers, but down huge from those 2022 numbers, and that is a pretty common theme between EBITDA and net income for Northrop Grumman. Taking a look at their total debt, we see $16.5 billion. We see assets of $48.2 billion and liabilities of $33.5 billion. All of those are relatively on par when it comes to looking at Northrop and Lockheed. Total debt came in a little lower for Northrop, but their revenue and net income were also lower, and so that makes a little bit of sense. Their assets were only $7 billion lower, and that's probably because they have a lot of similar facilities. It's likely that Lockheed just got a more recent contract or a more lucrative contract, and so that could help their revenue and profit a little bit. Looking at liabilities, we can see that Lockheed has much higher liabilities than Northrop, coming in at around $15 billion more. And then looking at shareholder equity, it's a different story where Northrop actually has almost double, actually a little over double, the shareholder equity of Lockheed Martin. Now looking at free cash flow, we see it kind of goes back to normal where Northrop is a lot lower. They're about a third of Lockheed, coming in at $2.5 billion, which was up from both years, coming at $2.1 billion in 2023 and $1.46 billion in 2022. Looking at buybacks, again, much lower than Lockheed. One thing that's interesting is their buybacks are pretty similar to their free cash flow. If you compare, you can see buybacks at $2.4 billion, $1.5 billion, and a little over $1.5 billion. And that's pretty consistent with their cash flow, coming in at 2.5, 2.1, and 1.4. And so it's pretty similar there. Their dividends have been pretty consistent around that $1 billion to $1.1 billion range, which is about a third of what Lockheed is doing. Looking at the ratios, we can see they have a good debt to equity. It's a little in that high range, but not as bad as Lockheed's at 1.12. A higher debt to EBITDA at 3.55, and then some decent margins. The 11% EBITDA and 6% net profit margin aren't bad. I think that 6% is a little on the low side though. Buybacks is a percentage of free cash flow and net income. As I said, they're about even, and so they're spending about half of what they could spend on buybacks, which is not bad. Their revenue CAGR is better than Lockheed's, growing at 7%, but their EBITDA and free cash flow, or actually just EBITDA, was negative at that negative 22, and free cash flow was at 30, which is pretty good for Northrop. The free cash flow number is good. They're bringing in more that they're able to keep, it looks like. Looking at the comparisons, we can see they do have a neutral debt to equity, a high debt to EBITDA, a neutral EBITDA, and a low net profit margin. Normally, a high debt to EBITDA and a low net profit margin would give them a yellow light, but because they're a defense contractor, they are really in no risk of going out of business, and so they are going to get themselves a green light. It's kind of a little bit of a like asterisk green light because they don't really fully deserve one, and if they were in another industry, they likely wouldn't get one. But because they are in the defense industry and the government would likely help them out if something happened, I'm going to give them a green light. And that being said, another thing that helps that is if we look at their debt, it's 16.5 billion, and if we look at their net income from 2 years ago, that's not too bad. And even though we compare this on EBITDA, just going back to the EBITDA, like it's down, and the year before that, I believe they did around $10 billion, and so their debt is pretty low for what the business has proven it can do. It's not what it is doing, but it has proven that it can do those numbers, and so if management can kind of get that back to where it was, they can probably figure that out. And so that could balance out that ratio and make them look a little better on my Excel sheet. Taking a look at the dessert, we can see the capital distribution. So total buybacks came in at 5.4 billion, which isn't bad, and that's again about half of what they could do for free cash flow, and so that 97% is a pretty good margin. It's a little bit better than Lockheed's when it comes to that percentage, and so that's something else that we can watch. They did $3.3 billion in dividends, and that's also not a bad number there. A pretty stable number around that billion to $1.1 billion a year. That gave them a total distribution of $8.7 billion, which was about half of their EBITDA for the last 3 years. And so one thing that we do have to watch though is obviously their EBITDA did get cut in a third, dropping from that like $7.5 billion mark to well, I guess it was more like a half because it dropped from 7 to 4. I think was thinking the net income at that 2.5 mark, and so that will affect that number because their distribution of $8 billion would be 60% of their last 3 years if they didn't have that huge, you know, 7 and some billion dollar year of EBITDA, and so that's something that we will need to watch. If we look at the shares outstanding graph for Northrop Grumman, it tells a very similar story to Lockheed Martin's, which is a huge drop from the early 2000s. In this case, dropping from 323 million shares down to 148 million shares. So that is a little over 50% bought back since 2009, and that is a very, very large number. If we look at the EBITDA graph that Macro Trends had, we can see that kind of big spike that they've had. This one is their fiscal year 2021, but some of that and that kind of does show up a little on those old numbers from the old yearly ones, and so that's another thing that we kind of need to watch. And we can see aside from that, it has pretty much stabilized. Again, another similar thing. It was during Trump's term where they kind of really picked it up, and they went from that 3.7 billion ish to a little over 5 billion, and then jumping up to over 7.25 for that time, and then stabilizing around that 4, and then dropping a little bit at the beginning of 2023. And so, or I guess that's more the end of 2023, beginning of 2024. The check for them is also going to be just the same as it was for Lockheed Martin, which is Trump's coming in again, and he's looking more budget conscious this time. And so that could have a big effect on the defense industry. This is a company that does, over $40 billion of revenue, most of that is going to be to the U.S. government. And so if their funding does get cut a little, that's going to hurt them, and that's going to hurt both top and bottom line. And so that's something that we are going to need to watch here. And so that's something we really do need to take into consideration um, looking at this company in the future. And so um, that being said, they're not going to get hurt too bad because the government has contracts with these guys and they can't really go against that. And so while funding might get cut in the future, for the next couple years, the company should be pretty stable and they shouldn't have much to worry about. I hope you enjoyed this video. If you did, feel free to like and subscribe. If you have another defense contractor or just another company in general you want me to do a video on, please let me know and I will try to get a video out on them for you. Again, thanks for watching.